Welcome to This Explainer. Today, we're putting on our detective hats. We're going step by step through a study tutorial on the statement of cash flows, specifically using the AASB 107 standard as our guide. Our goal? To uncover the real, no-nonsense financial health of a business. Because, as you'll see, following the actual cash is often the absolute only way to figure out what's truly going on behind the scenes of a company.
Okay, let's look at our roadmap. We are going to cover Section 1, Profit versus Cash Reality. Section 2, Defining Cash and Equivalents. Section 3, Operating, Investing, and Financing Activities. Section 4, Calculating Real Cash Movements. Section 5, Reconciling Profit to Cash. And finally, Section 6, Crucial Non-Cash Disclosures.
All right, let's jump into Section 1, Profit versus Cash Reality. We've got to start with a massive, fundamental disconnect in accounting. Now, you might be wondering why investors often look right past the income statement when evaluating a company's solvency. Well, here's the crucial point. Accrual profits can look absolutely fantastic on paper, right? But they inherently rely on subjective and, honestly, sometimes pretty creative professional judgments about when exactly to recognize revenue and expenses. On the flip side, cash flow data, that is the objective, factual reality of the actual money sitting in the bank. It's the money that actually pays the bills. Think about it like this. Profits are theory, but cash is fact. An investor looking at a stock relies heavily on cash flow data because it's a much more reliable early warning sign for solvency issues. It's a harsh truth, but a company can be wildly profitable on paper and still go completely bankrupt if it literally runs out of money to meet its daily commitments.
Moving right along to Section 2, Defining Cash and Equivalents. Since cash is king, what exactly counts as cash? Under the AASB 107 framework, it's obviously the notes and coins in a register or demand deposits. But standard setters also include something called cash equivalents, and they are super strict about this. We're not just talking about anything of value. To be a cash equivalent, an item must be a short-term, highly liquid investment held specifically to meet short-term commitments. Typically, this means a maturity of 3 months or less with almost zero risk of changing in value. It's kind of like a prepaid debit card you plan to use this weekend. It's locked in, ready to go instantly, totally unlike a volatile stock portfolio.
This is a brilliant example of how a real company applies this standard. If we look at the Qantas 2019 annual report, they explicitly reconcile their cash balance directly to their statement of financial position. Notice they don't just write down cash. They break it down into cash at call and short-term money market securities. By doing this, they're showing investors these funds are readily convertible to known amounts of cash, perfectly matching those strict AASB 107 rules we just talked about.
So, Section 3, Operating, Investing, and Financing. Let's break down where this cash comes from and where it goes.
This is a great way to map an everyday business scenario, like your local retail shop. The operating cycle shows the flow from buying inventory from suppliers to selling it, and finally, and this is the most important part, collecting the cash. It shows exactly why you want to keep operating cycles as short as possible. The longer your cash is tied up in inventory, the more you might have to rely on heavy, expensive borrowing just to survive the lag.
Now, if we zoom out to the whole organization, activities get grouped into 3 big buckets. Operating is the day-to-day stuff we just looked at. Investing activities, that covers buying or selling long-term assets, like a factory buying heavy new equipment. And then financing involves changing the company's financial structure. Think issuing new shares to the public or taking out a massive bank loan.
And standard setters don't leave much wiggle room here. AASB 107 has very specific rules to keep things consistent. For instance, interest received is generally an operating inflow. But what about dividends paid to shareholders? Well, they famously dictate that dividends paid out must be classified as a financing outflow. Why? Because paying a dividend is literally the cost of obtaining those external equity resources in the first place. Makes total sense, right? Let's move into Section 4, Calculating Real Cash Movements. Time to roll up our sleeves and crunch some numbers.
This is where the real detective work begins. Because the income statement hides actual cash movements behind credit terms and accruals, how do we calculate the actual hard cash receipts we got from our customers this year?
Well, we kind of have to reverse engineer it. Step 1, we grab our total sales revenue for the year. But since not everyone paid in cash, step 2 is adding the accounts receivable we were owed at the beginning of the year. Finally, step 3, we subtract the accounts receivable still sitting unpaid at the end of the year, along with any discounts.
Once we adjust for these changing balances, we finally back into the true cash number. And here is that exact formula brilliantly proven in action using T accounts. Let's say an organization made $600,000 in sales. If you map how their opening accounts receivable balance of $100,000 interacts with those sales, the closing balance, and the discounts, it reveals the true hidden cash figure right there in the ledger.
And what's the result of that calculation? $567,000. So, despite proudly splashing $600,000 in sales revenue on their income statement, the actual cash they can put in the bank today is significantly less. This right here is exactly why investors track cash. It cuts right through the noise.
Which leads us perfectly into Section 5, Reconciling Profit to Cash, the ultimate accounting showdown.
So there are two ways to present operating cash flows. Standard setters highly encourage the direct method because it transparently reports the gross cash receipts and payments. It's super clear, but in reality, a lot of entities still use the indirect method. This involves taking that highly subjective statutory net profit number we talked about and systematically stripping out all the non-cash items until it equals the operating cash flow.
To make the indirect method work, you have to strip out non-cash ghosts from your profit. Depreciation is the classic example. Think about a delivery truck. The truck wearing out over time absolutely lowers your calculated profit on paper, but does it drain a single dollar from your bank account today? No way. So to find our real cash flow, we literally have to add that depreciation expense back onto our profit.
And if you want undeniable proof of how massive this adjustment can be, look at Qantas again. In 2019, they reported a statutory profit of around $891 million. But look at their very first adjustment. They literally added $1.6 billion of depreciation and amortization straight back to their profit. After adjusting for a few other things like receivables, their true operating cash flow was revealed to be a massive $2.8 billion. That is a huge difference.
Okay, bringing it home with Section 6, Crucial Non-Cash Disclosures. Let's look at the fine print.
We need to look at what standard setters demand companies disclose about major activities that don't use cash today, but definitely will tomorrow. Think about a company buying a massive new headquarters and financing it directly with a mortgage from the seller. Technically, no cash changes hands today, so it misses the main cash flow statement. But under AASB 107, investors absolutely need to know about that huge new liability. So these major non-cash financing and investing transactions must be formally disclosed in the notes.
Companies also use these notes to signal future liquidity. It's almost like a financial flex. For example, BHP explicitly disclosed that they have a $6 billion committed revolving credit facility that is entirely undrawn. It's not cash in the bank right this second, but disclosing this massive safety net tells investors they have guaranteed access to liquidity if they ever hit a rough patch.
So as we wrap up this explainer, I want to leave you with one absolutely crucial thought. As you continue your studies, or maybe evaluate your next big stock investment, ask yourself, are you being seduced by a highly creative profit narrative spun on an income statement? Or are you doing the real detective work and following the indisputable trail of the cash? Because at the end of the day, profits are theory, but cash is reality. Thanks for joining me on this deep dive.